Welcome to the Scalable Real Estate Investing Podcast, where we discuss the most scalable strategies, tools, and approaches to successfully invest in real estate. Learn how to make the most impact of your time, automate your real estate investing business, find off-market deals with minimum time invested, and leverage your capital to create as many income streams as possible so that you can achieve true financial independence. Thank you for tuning in. I'm your host, Mason Clement. Hi everyone, Mason Clement here. Before we get into today's episode, I wanted to ask you one question. Are you sick of the wild swings in the stock market and ready to try something different? Did you know that investing in stocks actually put you at the very bottom of a company's capital structure, meaning that there's practically 0% chance that you're going to get any of your money back in the event that the company files bankruptcy? That basically you're putting yourself in the riskiest position for a questionable return. Personally, I hate the unpredictability and just waking up and having half of my investment gone when I didn't do anything wrong. So what a lot of people don't know is that you can actually make higher returns on a consistent basis by investing in the opposite end of the capital structure, which is actually the safest place to be, which is on the debt side in a first lien position. And you can do that by investing in real estate, and specifically investing with my company in notes that are backed by the land that we purchase. So if you're ready to diversify your income stream, go ahead and go over to scalablerei.com and click on invest in the top right corner. There you're going to find a form that you can fill out to determine if you're eligible to invest with my company, Celion Capital, and we'll be reaching out to you to schedule an introductory call and speak more from there. So thanks a lot, and let's jump into the episode. Hi, Scalable Investors. Today we have Neal Bawa with us, who is the mad scientist of multifamily investing, takes a data-driven approach to all of his deals. And I actually had him previously on episode 8, if you wanted to check out that one, but thought I'd have him on again. It's been a couple years, and obviously a lot of things have changed since then. So I think that we have a lot to unpack here. So Neal, why don't we jump into things? How are you doing?
Fantastic, Mason. Thanks for having me back on.
Sure, no problem. Thanks for making time to join us. So, like I mentioned, you were already on, so we went into some of your background then. It's been a while, so maybe just give some listeners, in case they haven't had a chance to listen to that first episode, a brief background on yourself and what you're working on today.
Sure. I am a data scientist by profession, computer science graduate. Call me a nerd, call me a geek. We use data science to basically figure out where to invest, when to invest, what asset class to invest in. We're steeped in Silicon Valley and mathematical style of thinking. We have about 900 nerdy investors that invest with us in 31 projects in 10 states, 17 metros. The portfolio is about $1 billion. What I like the most, though, is spending time on some of these podcasts talking about what are the trends in the marketplace, because the discovery process there really informs our investment philosophy, which is ever changing, especially in these strange times.
Okay, perfect. Yeah, it's actually a great transition into my next question. If you read the news, people are talking about some imminent recession, although I think technically we've already been in the recession, but buying opportunities don't necessarily present themselves yet. So why don't you just tell us about what are the biggest opportunities you're seeing for this year? You're in February, early February right now. So what do you think is going to unfold as we look on the horizon?
Yeah, sure. Can agree that we've been in a recession. I think all that happened was then Q1, Q2, our growth was below 0%. That doesn't necessarily constitute a recession. We actually have to see a fall in productivity, a fall in, an increase in unemployment. Didn't see any of those things. The economy in the Q3, Q4 timeframe was actually interestingly strong. So when you look at how many jobs we created in Q3 and Q4, you would normally just take that in a normal time and say, "Wow, I'll take these numbers of jobs being created." Especially the number in January was absolutely, or was it December? Was absolutely astonishing. 517,000 jobs in a single month is at any point of time, we would love that number. We'd love that number in 1999 in the middle of the dot-com boom. And so when you're seeing that we are continuing to see growth in the economy, and one of the reasons we're seeing that growth in the economy is people are not asking what I think is the obvious question, that when I'm looking at it from a data science perspective, my question is, how much has the economy grown since COVID overall? And how much would it have grown if COVID wasn't there? Right? So are we overheated, right? Then the answer is we're not overheated. We're actually underheated because the economy would have grown to be a larger economy if COVID hadn't happened. So we still have not recovered all the jobs back that we would have had if there was no COVID around. So I think that this concept that the economy is overheated is only in the Federal Reserve's mind. I think that the Fed is doing what they're meant to be doing. They are by nature a very cautious group, and they're being extraordinarily cautious at this point in time. But what's nice is that the economy is actually holding on well. And it has, the Fed started its assault 12 months ago, Mason, and even today, the unemployment rate is lower at 3.4% than it was when the Fed started their assault on the labor markets. And so the Fed hasn't basically managed to decrease unemployment at all over the last 12 months, but they seem to have had a significant effect in cooling inflation. Now, it's questionable to me whether that effect in cooling inflation had anything to do with the Fed. It may have actually been that inflation was transitory. It just took longer to get to where it should have been. So not being a economist, I don't know that for sure. But what I am seeing today in February is that while we are now beginning to see the impact of some of these rate cuts, the economy is still in a strong place and may, in fact, avoid a recession.
Okay. Yeah, part of the thing I was leading to, I know other folks have said maybe in Q3 you'll start to see some not so great deals start to unravel. Maybe there's more buying opportunities there. Do you think that's going to happen as like interest rates are going up and it's, higher debt service costs and all that?
Absolutely. So let's unpack that because what you just said is very interesting, but it has so many different parameters and so many different ways in which it could happen or may not happen, right? So let's first talk about why would these deals, exist? Well, firstly, what's happened is that over the last 5 or 6 months, as the Fed really aggressively started raising, remember all of their aggressive raises really happened May onwards. So it hasn't been a long time. It's really been 7 or 8 months. And the first few were not that aggressive because people either had rate caps or they had, or they had reserves. So it's the stress on these properties that have floating rates, right? So they had bridge loans with floating rates. The stress is really only built up in the last 2 months. I'll give you an example. Today, I receive one incoming request for distress equity per day. 3 months ago, it was one request every 15 days. So I'm up 15x in terms of distress equity requests just in the last 30 days. Compared to maybe 4 months ago, if I'm comparing now to 4 months ago, it's up 15x. And this is obviously a very small data set, so it may or may not hold, but I'm certainly seeing a massive increase. So 3 or 4 months ago, I think most indicators that had floating debt were thinking, well, I'm going to hold on somehow, or I'm not really sure what I'm going to do, or I still have operating reserves. And now those reserves are getting burned through. They're at the point where they don't have reserves. Something else has happened. As those properties that had interest rate caps, so these are properties that had rate caps and are right now in a pretty decent situation because of the rate caps. Well, what has happened in the last 6 months, they have started getting notices from their lenders saying, you need to buy a new rate cap because your rate cap's expiring in early or mid 2023. And rate caps right now are so expensive that we are going to escrow $50,000 a month or $60,000 a month so that you can buy this rate cap because we're going to basically force you to do it. And that number, that $50,000-$60,000 number, when you put it on top of an already existing increase in interest rates and decrease in income because of that, this is a double whammy. And this double whammy has gotten added on over time, and the amount of escrows are increasing as the Fed continues to raise rates. They just raised rates on February 1st again, 25 basis points. I expect that they'll do that 2 more times. And so as you can imagine, that increases the cost of the rate caps. And so now people have to deal with very, very large interest payments monthly and prepayments for rate caps. And the combination of those two is creating significant stress in the multifamily market, in any kind of market. I mean, I'm sure the hotels are in the same position. So are the retail people. So are the office people. But there's this stress that's being created. And this stress is aggregative in the sense that you don't feel it early and then you feel it and then you really really start to feel it, and that really really start to feel it piece is really Q2 and Q3 of this year, and maybe even Q4. So it'll keep growing. In Q1 we're feeling it. Remember, I'm getting an incoming request for distressed equity from some syndicator every day today. I've already gotten my request of the day this morning. Um, and I think it'll build in Q2, and I'll think it'll build in Q3, but I don't think it'll build in Q4. I think it's at some point Q3, Q4 it plateaus out and then it goes down. So this is a time sensitive thing, and we can talk about why does it plateau and why does it go down. But hopefully this is a good start to kind of make you understand and your listeners understand why this stress is building up in the system when multifamily continues to do well.
Okay. Yeah, it's really helpful context. I wasn't aware of lenders requiring this escrow in preparation for the new purchase, those cap rates. So that's interesting. And yeah, why don't we just dive into that a little bit more and why it'd be plateauing in Q4?
Absolutely. Right. So one of the things that is not known to most people that even invest in multifamily, and even is not known to syndicators, the people that are the professionals that are buying these properties, is this. When you buy a bridge loan, it's really composed of two pieces. One of those pieces is known as SOFR. It used to be called LIBOR in case that rings a bell. And now SOFR or LIBOR, especially SOFR, which is the new standard, very closely tracks what is known as the Fed funds rate. Remember, the Fed doesn't directly raise mortgages. The Fed raises the rate at which it lends to banks, so interbank lending. And when it raises that rate, it makes mortgages more expensive in general, but they can often go the other way. The Fed could be raising rates and mortgages could be becoming cheaper because of the all of the other factors in the marketplace. So the factor that is doesn't change is this SOFR. And so, for example, right now the Fed funds rate is about 4.5 to 4.75. It's actually a range, and the SOFR is at 4.3. So it tracks very closely but slightly lower than the Fed funds rate. So as you can imagine, SOFR is going to go up 25 basis points this week because the Fed, last week raised interest rates by 25 basis points. And so SOFR is pretty much fixed. So when you're you're getting a loan, you're paying SOFR plus. And that plus piece at the top is the most interesting piece because I am not at all predicting, and most people are not predicting, that interest rates are going to go down much this year, or at least the Fed fund rates, the rate that the Fed talks about, is going to go down much this year. With an economy this strong, I don't see the Fed really being in a hurry to drop rates. They might drop them 25 basis points or 50 basis points in October or December, but they're not really looking to do that before that time. So how do interest rates go down if that SOFR piece stays pretty much where it is? And remember, it's going to go up maybe a couple times more later this year when the Fed continues to raise, and then it might come down a little bit. So it's going to end up being right where it is. So what is this spread piece? So all the magic is in the spread. The spread is basically what the banks feel they should add to this so that they don't lose money on the loan that they're giving to Mason when he's buying a property, right? So Mason's getting a property in and they're like, okay, let's add something on top of this so that our risk is taken care of. Now, in a time when interest rates are very stable and there's the inflation is low, there's no indication that the Fed's about to raise rates. The spread's tiny, often can be as little as 1%. So you just take the SOFR rate and then you add the spread on top of that, 1.5, 2. Those are pretty common numbers in normal times. Right now, the spread's pretty insane. It's, some people are offering 3.5%, some are offering 4%. And all of that is just an indication of no one knowing where interest rates are going to be in 6 months. So everyone just takes the worst case scenario and sticks it on top of the SOFR. So what I can tell you is this: interest interest rates that we pay in multifamily do not need the Fed funds rate to decline. They simply need the Fed to stop, for the Fed to say, I think we're done. I think we're seeing the disinflation in the economy. The last time that last week, the Fed chairman said, we are now seeing signs of disinflation in some sectors in the economy. Disinflation is negative inflation. This is the first time they've used that word. And so now they're beginning to see some of the impact of what they're doing in some sectors of the economy. So as the Fed starts saying things like that, and maybe in March raises it by a quarter point and says, we think we're very close, and then maybe in May they raise it by another quarter point and say, at this point, we think it's best to hold and watch the economy for the next 6 months. The moment they say that, it takes the risk premium out of the market. And when the risk premium is out of the market, within 90 days, you should start to see that spread, which is as high as 4 percentage points now, collapse. And it could easily go down to 2. And for some amount of time, it might even go down to 1.5%. So now your interest rates are going to get a lot cheaper. But there's the catch. There's the catch. The spread is locked in when you lock in your loan, even if though it's a bridge loan, right? So the spread doesn't move up and down. So the people that have locked in, that not locked in, the people that have bridge loans, that have bought properties 2022, 2021, this spread collapse is not going to help them. It's not going to help them immediately because that their spread is already locked in, and so they have to wait for the Fed funds rate to go down, which I said wouldn't go down much, if at all, this year. So how do they benefit? How do they benefit from this? The answer is the rate caps. Rate caps I used to pay 50 or $100,000 for a rate cap. Now that rate cap is $1 million, right? Why? Risk. Because banks, the people that are selling the rate caps are charging these humongous amounts because they don't really want, they don't want the rate caps to be hit, and they've taken huge losses in the last year from rate caps being hit for everybody because everything above that is being paid for by the rate cap provider. But what if the Fed says, okay, we're stopping? Now all of a sudden the rate cap providers don't have to charge $1 million for their rate cap; they could charge 300,000. And once those rate caps come down, then the money that is currently being escrowed, 50,000, 60,000, 70,000 a month by these properties, now the lenders are like, I think we've escrowed enough money. I mean, you can buy a rate cap today for 300,000. This guy's already escrowed 400 grand with me. I think we're fine. And now all of a sudden, the distress on the property comes down because you're not paying 50, 60, 70 grand a month for some future rate cap that you may not even ever have to buy. That helps them, and I think it helps them in that Q3 timeframe, even without buying a property. Here's something else that helps them. The people that are buying properties today, they are having to pay these high interest rates, right? Because they're calculating, because the market has been rising and the interest rates have been rising. So if Mason's buying a property today, he's being very conservative. So Mason's saying, okay, I'll take the SOFR and then I'll go call my lender, and the lender says 4 points on top of this. Well, that's how I'm going to do my underwriting, right? What if in Q3 that 2 points is now, so that 4 points at the top is now 2 points? It drops. Well, Mason would be willing to pay more for the property then. Mason would be willing to sharpen his pencil and be more aggressive because he's paying a lower amount. Because remember, once that spread is locked in, it's locked in. It's not floating. The part of the debt that's floating is the SOFR part, right? And then at that point, if the Fed stopped, then Mason's thinking at some point in the future, SOFR is going to go down. So my mortgage is going to go down. So I'm going to sharpen my pencil. Maybe I can pay a little bit more. And all of a sudden, the market comes back. So those people that have these properties that are bleeding money because of high interest rates, bleeding money because of rate cap escrows, all of a sudden they can sell their property and they don't have to sell them at a distressed price. And this change is probably going to occur in Q3, Q4, maybe Q1 of next year. And some properties will be sold, and some properties, unfortunately, because their value has decreased, will still be in distress and will have to be bailed out through funds like mine, distressed equity funds. And then some properties will end up going back to the bank. But I would be surprised if a large number of properties, thousands of them, went back to the bank, because I think that there's many steps between now and then that will help these properties. As I said, some syndicators will put in more equity and they'll be able to help their properties through this transition, knowing that there's Q3 and Q4, there's relative safety compared to today. So hopefully I gave you kind of all of the different scenarios that properties could be in, and that's why I don't see a lot of distress happening until Q2 or Q3, because that's when all of the operating reserves are burned down. But if they're lucky enough, by Q3 we could also have some good news.
Okay, that makes sense. Yeah, I guess to a certain extent there could potentially be distressed properties anywhere, but it sounds like you're saying that the floodgates aren't just going to open wide and just have tons of opportunity here. It's maybe here and there.
It truly depends on how much the spreads collapse. If the spreads fully collapse down, you're not going to see a huge amount of opportunity because people will be able to sell their property without doing a distressed sale, right? They'll just get their investors' money back, or they'll get 90% of their investors' money back. That doesn't really create much distress in the marketplace. I'm sure those investors are unhappy because they didn't get all of their money back. But it doesn't create much distress in the marketplace because it doesn't really drag the whole market down. But if the spreads stay up, if the spreads stay close to 3.5, 4% on top of SOFR in Q3, then you should start to see severe distress because by that time, all the operating reserves have been burned down. The syndicators have put some of their own money in. Maybe they've even done a cash call and they're still properties in trouble, and cap rates haven't turned around. Cap rates have a role to play here because cap rates right now are pretty high compared to where they were a year ago. They're significantly high, especially for Class C properties. They're in the fives, where they used to be in the low fours, and so they've jumped up. But they can very easily jump down because the only reason that cap rates jumped up and property values came down was because people couldn't afford to finance those properties. If the spread collapses, then within 2 quarters, we could start to see some cap compression happen. When does this happen? It's really all dependent on those spreads. When do they collapse? How much do they collapse by?
Okay, yeah, time will tell. Very interesting. So on your own projects, do you usually use fixed rate debt or you also use similar adjustable rate bridge financing?
We mostly use adjustable rate debt. And I think that today, knowing what I know about the economy and the marketplace, I actually wouldn't hesitate to use um, I wouldn't hesitate in the future. I'm not buying at this point in time, but if I was buying, let's say in Q3, I wouldn't hesitate to use bridge debt and floating debt. A lot of people are like, why? You know now what you know, you should be using, this, you have to learn from this. And the answer is when you think rates are going to go up, you definitely want to use fixed debt. When you think that rates are at a plateau and may actually have a chance of decreasing, spreads may have a chance of decreasing, that's actually considered to be the best time to use bridge debt because now you can benefit from those rates going down and you don't think that the chances of them going up are as high. Would I buy a rate cap? Of course I would buy a rate cap, right? So I'm hedging my potential losses in case the rates continue to go up in the future. But once the Fed says we think we're there, I think everyone should be buying bridge debt, but that's not what's going to happen. People have been so burned by what's happened in the last 18 months or 12 months that I think everyone will buy fixed debt. And I think that will be problematic because that will make their properties illiquid for a number of years.
Huh, yeah, that's really interesting. So you said you're not buying right now, so you're just kind of a wait and see holding pattern?
So I think that we are seeing decline in prices on a per door basis, especially for Class C properties. So Class A, they sort of adjusted, and then now it's sort of there in the low fours, the mid fours. We're seeing Class C now adjust into the low fives, so 5 cap, 5.1 cap, 5.2 cap. I believe that in Q2, that number will be potentially the highest cap rate, lowest price. So I'm really looking to lock in my properties in Q2 and give myself as much time as I possibly can to lock in that rate and buy the property because what I really want is to sit on a bunch of properties that I have in contract in late Q2 and I want to sit on them all the way through Q3 into Q4 so that I get two benefits. One is the compression of the spreads and then potentially if I get lucky maybe even get the Fed cutting interest rates by 1 or 2 25 basis points. Well, that's 0.5% for my loan. I'd love to have that benefit. So I want to basically not buy properties, but put them in contract with terms that allow me to kind of string it out for a while, um, for maybe as much as 6 months, and keep basically paying more deposits or a slightly higher price for the property so I can string it out over time.
Okay, interesting. And I know that you've also done some development, ground up development type of projects. What do those look like right now? Is it like the worst time to do that? Or are you still considering those?
So it really depends on what stage you're at. So the short answer is I think it's a pretty awful time. I wouldn't say worst. I've been through worse. Um, but it's a pretty awful time to be getting a construction loan and locking it in Q1 2023. I think Q2 2023 will be better. Q3 2023 will be even better. And the reason for that is the spreads. Remember that risk premium is even larger for new construction. So you're still doing the SOFR plus spread, but the risk premium for new construction is even larger. So we are seeing spreads almost as high as 7% on top of SOFR. So between 3.5 and 7% is the spread that we are seeing. And we think that this spread will collapse once the Fed holds. So if you're at the point where you're buying a piece of land and you're going into zoning and permitting that 18-month cycle, I think it's a great time to be doing that. It's an awesome time to be doing that because you're not overpaying for the land. That frenzy on land purchases that was happening a year ago, where you were just paying a ridiculous amount of money, is no longer there. Land prices really haven't gone down much, which I'm scratching my head over, but they're not super aggressive. I mean, if there were 30 offers on a piece of land a year ago, now there's probably four. And you have the ability now, instead of buying the land in the next 4 months, to string it out over 18 months and get more extensions and more extensions and more extensions. So you're not really paying for the land until you've reached shovel ready status, right? So no, those two things are pretty awesome. And so knowing that, and also knowing that construction costs are finally beginning to stabilize, material costs have stabilized, labor cost, I think, stabilizes sometime this year, maybe later in the year. Knowing that, why wouldn't I want to be in a position a year from now to build a property? So if you're starting work on a property now, I don't see anything wrong with it. If you're starting the construction loan now, meaning you're shovel ready, why don't you wait?
All right. Yeah, that makes sense. And if the seller is really just pressuring you to act right now, like I'm actually under contract right now on one where they want to close in a couple of weeks. It's like, you know what? I just don't feel like this is the best opportunity. And
Okay,
I've I've raised a portion of the equity already, and it's like I should just go back to my equity investor and say, wait, guys, let's just pump the brakes and wait.
Mason, 100% wait. So let me give you two anecdotes. I bought a piece of land in Port Charlotte. This is actually my personal 1031 money coming from a project. Um, so I went back to them and said, look, I've given you $50,000 of hard money. I'm willing to walk away from this hard money. We have two options. One, give me 12 more months to close. Two, give me a discount. So it was 2.125. They gave us a discount. They still wanted to close because they had something that they were buying. And so we paid 1.9. So I ended up basically with a 11% discount on that property. The second property was in Idaho Falls, also was 2.1 million. I went back to them and said the same thing. Basically, either give me a big discount or you got to give me time. They didn't give me either, Mason, but they seller financed the property. So what they did was they allowed me to get a 60% loan on the property, right? And then the remaining 40%, the equity is actually coming from them. So I don't have to raise equity for the next year, right? So they gave me a year to raise my equity, which raises the IRRs, gets me to shovel ready without involving investors. So both of these deals, and the second deal, by the way, I had $175,000 hard. 12 months ago, if I had told somebody that I'm going to walk away from 175 grand, they would have laughed at me. Today, they basically gave me $800,000 of their money for free for a year, right? So, and I still didn't get a discount, Mason. So I still paid a hefty price for the property, but I got flexibility. So today, if you're negotiating, regardless of how much hard money you have in there, you have room. Every reasonable, seller is negotiating, and you should be negotiating 100% of the time, not even once, but multiple times.
Okay, that makes sense. Yeah, we've this particular deal we've explored seller finance and looked at it in a number of different ways. And yeah, we could talk about it all day probably on that particular one. We can move on. But how do you evaluate? You say you got Idaho Falls, Port Charlotte. How do you evaluate like a specific piece of land? Is it like a minimum amount of vehicles per day or other metrics you're looking at to determine the viability of a
Lots
property?
of different metrics. I mean, the first thing I'll do is look at the standard demographic metrics. So, right, so I'm looking at a metro itself, and I'm also looking at the greater MSA. So Port Charlotte is part of Fort Myers. So I'm looking at job growth, income growth, home price growth, crime. I'm looking at all of those pieces, and then of course because it's Florida, I'm looking at insurance rates. I'm looking at what happens if there's a Category 5 hurricane that hits my city. All of those are Florida specific. I wouldn't do those in Idaho Falls, but obviously I'm allocating more money in my budget for insurance, for example. And I'm also going to raise the land a little bit more so that I don't have flooding. Things like that add to my cost. And it's part of the underwriting process. And then once I look at those, which are standard demographics pieces, then I'm looking at the piece of land itself. I want to see where this piece of land is, what's being built around it, what are the prices around it. Are people building single family close by, multifamily close by? Is it apartment row? How much visibility does it have from the road? How many vehicles are going past? those sorts of things. And then I look at what am I looking to build here? Is it high density residential? Am I building apartment complexes, 20 to 30 an acre? Or am I building build to rent, which tends to be more like 12 to 15 an acre? In most cases these days, I end up with built to rent simply because it's more stable. But there are many cases where the shape of the land suits, apartment complexes more, in which case I'll build apartments. There's a lot to go through. There's, local builders. I want to see if local lenders are willing to give me a land loan. I want to see if local builders are drinking the Kool-Aid that they're still going to be busy 2 years from now, or they're more reasonable and they realize that in about 6 months their pipeline is going to have some abrupt declines, and so they should quote accordingly. All of those factor into my decisions to build something. And I'm one of those people that if I'm not feeling good about it, I'll just wait for 6 months. I'll just wait for 12 months.
Okay. Can you go into that a little bit more on why you feel build to rent is more stable, like relative to multifamily or relative to what?
So when you're building, no one really builds Class B or Class C. Class C is just older Class A's. Once they're 30 or 50 years older, they become Class C's. Class B's are basically 15 or 20-year or 30-year old Class A's. Pretty much everyone in the US that is currently building apartments is building Class A, simply because the prices don't make sense. If you were to price out a Class B apartment complex, your construction cost would be so high you wouldn't make any money. So by default, everyone has to build Class A, right? So when I'm looking at build to rent, I'm actually comparing it with the risk of a Class A apartment complex because that's the only kind I can build, only kind anyone can build. Now, let's look at build to rent. What is build to rent, right? So build to rent is small townhomes. In my case, I mostly build townhomes, or small single family homes that are designed for rental. So they don't have pools in their backyard. They're not 2,500 square feet. They're not even 1,500 square feet. It's 1,200, 1,300, 1,400 square foot townhomes or single family homes, postage stamp size front yard, postage stamp size backyard, either one garage, enclosed garage or two enclosed garages. And then the whole community has a pool and a gym, right? And so by doing that, we give people the ability to think that they're living in their own home. They're living in a home. They're not living in an apartment, right? Because they're in a townhome, they're in a single family home, they've got a little backyard, and the kid can play in the backyard. And then they've also got the amenities that they have from a typical apartment complex, the pool, the gym, etc. What I find is that it's sad to say this, but 30 million Americans will never be able to rent to build a home because of all the inflation that we are seeing in the economy, all the inflation that we're seeing since COVID, all the increases in home prices. So home prices have increased 45% in the US. In my markets, they've increased more closer to 65%. I think they're going to come down 15%. That still means they're up 50% from COVID. No one in the US, no state, no city has gotten a 50% increase in salary in 2 years. No state has even gotten a 20% increase in salary in the last 2 years. So what's happened is that we now have tens of millions of families that just because of what happened in the last 2.5 years will never be able to buy a home. But these people, they have they have this dream of owning a home because their incomes are not bad. They make $100,000 dual salary or $80,000 single salary. Their dream is to live in a home, and the only way to make that dream come true is to go live in a built to rent community. Because when they are inviting people in, when people are coming to their home, when they're living in it themselves, they feel like they're living in a home. And as a result, we are seeing, and this is your question. Mason's question is, why is it more stable? Well, it's not because of any of those things. It's because of the final piece here. They feel like it's their home. We are seeing built to rent occupancies extremely high and staying high because of the fact that people think that it's their home. The tenant quality is higher. The average built to rent tenant has $5,000 in their bank account. The average, a tenant might have $500. Actually, it's quite a bit higher than that. It's more like $20,000 in their bank account for built to rent tenants because they're one notch above Class A tenants, right? And Class A tenants tend to be about $10,000 in the bank account. So, bottom line is, because they think it's their home, they're living for 4, 5, or even 6 years, whereas the average apartment tenant lives for about 2 years. It used to be 20 months, but recently, it's been longer. So about 2 years. And we all know in the apartment business that what is the true killer of profit? Churn, turnover. Because when turnover happens, we have to spend money on the unit. and we don't make money on the unit for 1 to 2 months while we're releasing it. And that's what kills half of your profit. What if what if every single unit in your community was occupied for 6 years on average instead of two? Can you imagine how much more profit you would create? And how much more stability would you create? If it's a bad time, you simply don't raise your rents. But and by doing that, you basically your occupancy stays high because your tenants have more money than a Class C tenant who has $500 in their bank. That is why I'm interested in BTR. That's why I'm more focused on BTR. But there's plenty of apartment projects I'm still doing.
Okay, that makes a lot of sense. It's really helpful, all those different data points. So for you to actually consider doing a BTR development, does it really need to be within like the primary market or secondary, or how far away from a city center would you be willing to go?
Currently, most single-family built-to-rent developments are in secondary and tertiary markets. What's being developed and what's being delivered appears to be in secondaries and tertiaries simply because the cost of land and the cost of construction in the primary is too high. There's projects that I see here and there, but if you were to look at what's in the pipeline, 44,000 units, a lot of it is secondaries and tertiaries because that's where we can afford single family. Townhomes, the same is true, secondaries and tertiaries, but now those secondaries are a little bit closer to the town center. So, for example, I'm building townhome style built to rent, which is only about 10 miles, 11 miles from downtown Austin. I can't afford to get any closer, but 10 miles is not too bad, right? Somebody could, drive there and live in my property and still have this townhome style built to rent feel. Um, where if I did single family homes, I think the closest I can get to Austin downtown is about 35 miles.
Okay, yeah, that's very helpful. And the reason I'm asking all these questions is because I focus on land exclusively, and I'm always looking to see, well, can I subdivide this, or can I possibly partner with someone and do some build to rent? I haven't done a build to rent yet, but I've been obviously learning a lot about it, and it's very interesting stuff. So when you're looking at a potential site, do you have like a minimum amount of acreage that you require to do something?
It depends on what it is that I'm going to be putting on it. My focus for the moment is, either, high density townhome style where, I'm trying to put 18 to 20 units in there, or it's the smaller single family. Right now, I'm looking more for smaller single family because I've done a lot of the high density townhome style stuff. So in that case, anywhere between 8 and 12 units an acre. So I have a project in Idaho Falls that's 12 units an acre. The one in Port Charlotte also looks like it's 12 units an acre. Those are townhomes, row townhomes. But I also have other projects that are closer to 8 units an acre, maybe 9 units an acre, and those are single family homes. Again, small single family homes, small backyards, small front yards.
Okay, got it. Yeah, maybe I could even share my research with you offline about like what I've looked at for this market. Although it's about half an hour from the city center of San Antonio, so I'm not sure if it'd be too rural for you, but again, we can talk about it later on that. I could show you kind of where on the map and all that. Maybe looking at demographics more, but um, say like I'm trying to build my investor base for that specific project or something else. What do you think are the best ways to find investors? Like, is it, I mean, obviously there's word of mouth because you have that trust there and a warm referral, but do you also recommend doing like some online ads, like Facebook advertising or some PPC campaigns, anything like that?
I think most people that have done Facebook ads and PPC campaigns have failed. So because the cost is extraordinarily high. So the general answer is, as far as I know, Facebook ads and PPC campaigns do not work because the overall cost is so high. They work for me. So I haven't, PPC has been too expensive. Google has been too expensive for me, but Facebook has not. And the real reason for that is we spent 3 to 4 years building tracking accredited investor Facebook accounts. So we create custom audiences for Facebook because the audiences that Facebook creates are not rich enough. They don't give us enough money. They're not accredited enough. The dollar numbers are not high enough. So we basically gave up on trying to have Facebook pick the audience, and now we create our own audiences. We have 4 team members full time whose only job in life is to create and aggregate these audiences so that we can upload them to Facebook. In that scenario, it is possible to make it work, but you have to have extensive knowledge of their net worth and the fact that they're interested in real estate, and that is very hard to do. In general, I would suggest that the Facebook and PPC, route is not the right route to find investors.
Okay, that makes sense. So maybe just more word of mouth and getting referral of a referral or something like that. That's kind of what I've found through my experience so far, at least. I might talk to a close friend or family and say, well, I may not be able to do it, but I have a friend that has been looking for an opportunity like this. So,
Yeah, I think there's nothing like referrals because they also close quicker, meaning, you're able to get to the dollars quicker. For us, obviously, since we have 900 investors, we get referrals every week, but we are not dependent on them. We still believe that we should go out there and find more investors.
okay. And I guess as a capital raiser, it's always the goal, right? Is to always be looking for more investors, right?
Always be raising.
Okay, cool. Well, that leads me into just a few other questions about coming up on time. But I know that on other podcasts we've talked about like securitization token offerings, and it's kind of like way left field thing from what we've been talking about. But it just seems like a simple thing where maybe you don't have to register with SEC and go into like a formal, 506 C or B offering. But could you just talk about that? And like, are people even doing these STOs and offering real estate syndications on blockchain and stuff like that?
So people are doing STOs, securitized token offerings, where they're essentially taking one share and breaking it out further. So it's not a $50,000 or $100,000 syndication share. They're breaking it down to, $100. For the moment, all of these are dead because the crypto market's dead. As dead as any market can be. I'm sure it'll recover in 2024, but the interest from anyone, including investors, is maybe a tenth of what it was 18 months ago. Um, and in general, the Securities and Exchange Commission, the SEC, has been so badly burned by what is happening with FTX, what is happening with, a bunch of other exchanges and challenges, that they've been increasingly, very aggressively making statements that when you tokenize, you are still 100% subject to SEC rules, whether it's a 506B or C in the United States. That was a gray area before, but now the SEC has been very, very aggressively providing this information. So I've been a advocate of tokenization. I have been a evangelist of tokens, and I can tell you today it does not work. The people that are doing it are wasting their time. I think that there's a glorious future for tokenization, but I don't expect that glorious future to arrive in the next 2 or 3 years.
All right, that makes sense. Yeah, it's a time and place for everything. So maybe not the best time right now. All right. So last question, you mentioned you have like 40 people doing full-time Facebook audiences. So I imagine that's some army
Four.
of four, not 40. Okay. Regardless, though, I know that you're really an expert on finding virtual assistants and having them do just various different tasks. So could you just talk about that briefly? Like what's the best ways to find them and screen them and train them?
Sure. So virtual assistants, people that don't live in the United States, are a key part of real estate, and no real estate company in the U.S. should have any less than 50% of your entire workforce be in the Philippines or in Mexico, whatever country you pick these folks from. Both of those are good options, by the way. To me, the ratio is roughly 60%. So 60% of the 35 people employed in my company are in the Philippines. They are full-time. They're full-time employees. They're not flex employees. They don't work for anybody else. In fact, they cannot work for anyone else. They work US hours. It's not a flex time position. It's just work from home. And they are weaved into every single aspect of our company with the exception of banking. Obviously, since they're not in the US, we can't allow them to touch funds, but they're interweaved into every other aspect of our company. For example, you gave me the example of marketing. So that team, that basically the 4-person team that creates custom audiences that we use on Facebook, 3 members are outside the US. Actually, 2 are in the Philippines. The third member is in the Ukraine. And then the director of that division, which is the director of growth hacking, is an American. So by doing that, I'm using these extraordinarily talented people who know what they're doing. They're experts at their jobs. They have great experience, and I'm able to use them just like I would use people in the US. This is not a cost-cutting initiative. In fact, everyone who tries to cut costs by using people from outside the US has had very disappointing, results. This is a scaling initiative. So essentially, instead of hiring 35 people in the US, I'm hiring 35 people or 21 people in the Philippines and 14 in the US. So it allows me to scale my business, or allows me to grow my business and do more things. But when I start looking at it as cost cutting, that's when it starts to fall apart. Now, the process of hiring, recruiting, training these people is so complex that I can't even do it in a podcast. I've actually done a webinar with PowerPoint slides, and this entire webinar is on my website, so multifamilyu.com. Thousands of people have watched it, loved it. I get wonderful emails from people that use it in their companies all the time. So it's multifamily followed by the letter u.com. Go in there and look in the webinar section, and you'll find a webinar that says how to 10x your business using virtual assistants. And in there are a series of demos on how to hire them, train them, keep them accountable. It's stuff that we've learned over the last 5 years, so it's incredibly powerful.
Okay, perfect. Yeah, I'll be sure to drop that in the show notes. But that's a perfect ending time, right on the time here. So people can go to multifamilyu.com to find out more about you. But is there any other places you want to send people if they want to learn more about what you're doing? And
Sure. If you're interested in our data science, how do we pick properties? Type in Udemy or Udemy, whichever way you like pronouncing it, which is the most popular online course website in the world. So Udemy space Neal Bawa, and you'll see my Udemy course. There are currently 11,000 students that are enrolled. I'm sure most of them are real estate investors that are learning how you can use demographics to boost your profits. The course has no fee, it has no subscription, it has no higher version. There's nothing except the course itself. I don't even get your email address. So you can check it out there. The version of that course that is on my website, Multifamily University, is actually better because it's more recent and it's got 2023 content. It's called How to Find the Hottest Real Estate Markets. Once again, it's free. There's no subscription. There's no higher version. It's always meant to be free. There's actually 20 plus webinars that we do each year on multifamilyu.com. And the purpose is simply to engage with the community and find investors that are like us, slightly geeky, dorky, nerdy. They like, you know, statistical analysis. They like data science. And so we feel that that's the realm that we are comfortable with, coming from, we're combination of data scientists and software architects. So we feel very comfortable in that realm. And so we tend to attract the investors that are also very data driven. So a lot of this really is through multifamilyu.com. You can also search for me. I'm the only Neal Bawa on the World Wide Web. So you can simply just type in my first name and last name and hit enter, and you'll see thousands of articles.
all right, perfect. Well, thanks a lot for jumping on. This has been very helpful.
Thanks so much, Mason. Thanks for having me on.
Hey guys, I appreciate you taking the time to listen or watch this episode. As you might have noticed, we don't run ads, but what I would like you to do is just subscribe to our YouTube channel. That would help us out tremendously. You don't even have to leave a review, but if you do feel like you would gain a lot of value from this episode, feel free to share it with your friends and comment, like, subscribe, all that. But subscribing to YouTube would be what helps us the most. That's the only thing I ask. Thanks a lot. And if you do want to get in touch with me, feel free to email me at mason@scalablerei.com. Thanks a lot.